Hello everybody, my name is Dan Spear. Thanks for tuning in. Today we are talking about how to get invested with market-changing or market-creating companies. These are the types of businesses that a venture capital firm would be interested in. Now, I know most, if not all of my viewers do not have the funds to write a $10 million check to a venture capital firm, but there is growing popularity in something called a SPAC, or a special purpose acquisition company. These are the types of deals that have been around, but only up until recently have they been involved in acquisitions that really excite public investors. So let's break down what a SPAC is, how they are created, let's go over some examples, and I'll show you why you should consider investing in a SPAC. Not many are talking about this, but I can't wait. Let's get into it. So a SPAC, again, is a special purpose acquisition company. These are also called blank check deals. They are very unique and allow public investors to invest in a fund that is used to acquire, hopefully, what ends up being a very promising company. Basically, a SPAC is led by a group of popular or trusted investors who go to the public markets and offer units of the SPAC for a defined price. They are raising cash. The number of units, which is usually priced at $10, determines how much cash the SPAC is looking to raise. This in turn determines how large of an acquisition can be made. In the last couple months, Social Capital launched two new SPACs, one raising $300 million and the other raising $720 million. And as of last week, famed investor Bill Ackman announced he was doing a $1 billion blank check deal. So these are some really big time acquisitions. So when a company goes through the normal IPO process, they are listing their shares for sale on the public exchange. And public investors like you, me, or a hedge fund buy those shares from the company. The company takes our cash and uses it to grow the business. Now with a SPAC, we are giving our money to an investor who then goes and makes an acquisition. So with the normal IPO process, you know what company you're buying a share of. With the SPAC, you're speculating that the fund manager will make a really good decision. So to dive deeper into the specifics of how this works and why it's beneficial is that it helps get companies to public markets quicker. The SPAC units are already traded on the public exchange, but there isn't any business activity. It's just a shell company. So the shares really stay around $10, which is the offering price. Basically, a SPAC is a bank account of which you own a small sliver of. And then when the investors or the fund managers decide on a company they're going to acquire, once that deal goes through, the acquired company is now traded on the public exchange, but the process is much smoother. Traditionally, there's a long drawn-out process with the SEC, creating a valuation, doing a roadshow, and so many other factors that could decrease the total proceeds from selling a piece of a business to public investors. There are extremely high investment banking fees, and the skill of the bankers in creating a share price that investors will respond well to, combine that with the timing of market emotions, these factors, even if missed slightly, can greatly decrease the amount of actual capital received from selling a piece of the business on the public exchange. And keep in mind, a lot of these owners of startup companies want to have their big liquidation event. With a SPAC doing a blank check deal, there aren't the same investment banking fees, the timeline issues, or the roadshow worries. The SPAC has cash ready to deploy once they make the offering. And then they have a talented set of investors that often become key members of the company or the board of directors that they acquire. Also, we need to discuss the constant mispricing of IPOs in the traditional method. Investment bankers have left probably $1 trillion on the table in the last 20 years from business owners because they misprice IPOs. I'm talking underpriced IPOs, and to add to it, they take a gigantic 5 to 7% fee. It's practically robbery. So SPACs are already getting some traction recently. They've been around for decades, but only recently have they made some headlines because they're starting to acquire really interesting companies. Previously, companies that were acquired by a SPAC, that was their last resort to get to a public market. But now, you have these really talented and innovative investors with a forward-thinking mind trying to buy these really cool, innovative companies that will be huge market players in years to come. Have you heard of Virgin Galactic or DraftKings or Nikola Motors? These are stocks that have shown some serious gains and are extremely innovative companies. Virgin Galactic is the only publicly traded space tourism company. DraftKings is perfectly positioned in the ever-growing sports betting market, and Nikola Motors is yet another electric vehicle startup. But as a side note, let's not compare it to Tesla. Tesla is light years ahead and has a lot more to offer in the energy business. But anyways, these are all from SPACs, okay? Let's look at the returns of these. Virgin Galactic, trading under SPCE, reached an all-time high of $42. Nikola Motors, trading under NKLA, reached an all-time high of $94. And DraftKings reached an all-time high of $45. Those are some serious returns when you consider these were SPAC units offered at $10 a share. Nikola Motors almost was a 10x on that. This is way better than the S&P 500, but be prepared for risk. It's a lot more volatile. Even in this past week, there have been two more big, high-profile SPAC deals, one under FMCI and the other OPES. These two SPACs purchased a food preparation business and a burger business, respectively, and the shares almost doubled upon the announcement. Given that these companies are not churning out gigantic profits yet, or in the case of Nikola Motors, not even producing a car or even $1 revenue, they're all very speculative. But let's go back to a video I did a couple weeks ago about the premium investors pay for innovation. These SPAC deals are targeting speculative companies that have huge future potential, and that is really exciting investors. So what's next? How do we prepare for this wave of SPACs? Remember when I said Virgin Galactic was a SPAC deal from a firm called Social Capital? Well, they have two new SPACs trading right now. They're trading under the symbols IPOB and IPOC. Virgin Galactic at one point was IPOA. They actually trade at a slight premium to the cash held in escrow. But again, it's because investors are preparing for this super intriguing business that's about to be purchased. People are excited about the investors such as Chamath behind Social Capital. They've seen the success of Virgin Galactic. Now they're ready to go for IPO B and C. So in conclusion, a team of investors creates a shell company that has no business activity. They offer units of that company for sale to public markets to raise cash. They then take that cash and they buy a business that hopefully becomes an industry changer or an industry creator. And then they make that process a lot easier for that company to come to public markets and a lot less expensive. It's actually quite effective if there is the right leadership behind these deals. I mean, I'll go back to Chamath. He's literally a genius. He was behind Facebook. He's been a big Tesla promoter. He's been behind the SPAC doing Virgin Galactic. He's really impressive. So go ahead, throw some shekels into a SPAC with a really innovative investment team behind it, but buckle up for some volatility, okay? This is not a surefire thing, but it is really exciting. So that's all I have for you today. I really hope you enjoyed. If you did, smash that like button, hit me in the comments and subscribe. Take it easy, everybody.